All right. So sometimes when we're determining the progress towards the completion of a contract, we could look at an output based, and that's what we just did in the previous example. We provided that service of that subscription. It could also be input based, measured on a proportion of the effort expended thus far relative to the total effort expected to satisfy the performance obligation. So it could be based on output based or input based. Okay, so we're going to come down here and we're going to go through an example where we have more than one service obligation. So they have our little process here, identify the contract, identify the performance obligations, determine a transaction price, allocate it, then recognize revenue. Okay, so we got a lot of stuff in this next slide. Okay, I'm going to circle some of the things that we need. Let me move my screen over a little bit, and I am going to write a little blurb of information over here. Okay, so TrueTech Industries manufactures the TriBox system, a multiplayer gaming system allowing players to compete with each other over the internet. The TriBox system includes the physical TriBox module as well as a 1 year subscription. There are two things here. We have the box and we have the subscription. Okay. So TrueTech sells the individual 1 year subscriptions to TriNet platform for $60. I'm just going to come over here and write that. Okay. And they sell the actual module for $240. Okay. Customers can use the TriBox to access the TriNet as well as multi-user gaming platforms. As a package deal, TrueTech is going to sell the box and the subscription, which is a total of $300. They're going to sell it for 250. Okay. We can't just go record revenue for these amounts right here. These two are standalone rates, the 250 for the box and the $60 for the subscription. Those are each can stand on their own, and which is makes it a little bit easier when you are trying to calculate these numbers. So here we're going to do the first thing we're going to do is we're going to take the 240, divide it by 300. You should get 80%, and then we'll take the 60 and divide it by 300 as well. So we'll get 20%. So we will allocate for the box 80% and then the subscription 20%. We'll multiply those both by 250, and they have the numbers on the next slide. I just wanted you to see where I got those numbers from. Okay, so we identified the two items that could be completely separately identified. Okay, got a contract. We have the two things. We have the module and the subscription. Okay, and here we go. Here's the total transaction price for the 250 per system for 1,000 of those. 250,000. Okay, so really your 250,000 will get multiplied times 80 for the box, and then 250,000 will be multiplied times 20%. Okay, so here we go. We've already done this, some of this. We took 80% of the transaction price, 250. Here's the math that I did, trying to come up with the 80 and the 20%. I did that up above just so you could kind of see us pulling the numbers out of that paragraph and doing that calculation there on the side. Okay, so 80% is 200 will be allocated to the module. $50 will be allocated to the subscription. Okay, so we are going to bring in 250,000. Okay, so let's just think. We're They bought this on credit, so we have $250,000 that is going to go in accounts receivable. Okay, 200,000, which was the 250,000 times 80%, or That was 200 times 1,000 modules. Okay. And then the other one was $50 multiplied times the 1,000. Okay. So 200,000 gets recorded as sales revenue right then on January 1st. Okay. The other 50,000, we're going to defer that off into the future because it's going to cover a year. We didn't earn revenue right here. Okay. We're going to gradually earn that 50,000 over this year period. Okay. So each of those months, we will make this entry very similar to the previous one that we did, except we had two obligations in one contract right now. Okay. So divide that 50,000 by 12, you get $4,167. We are going to record that every single month. Okay. For 12 months. And you can see here, our deferred revenue started with 50,000 in it. By the end of the year, we've earned all of that because every single month we've made this journal entry gradually accruing and recording revenue that we have earned because we earned it then. As we provided the subscription, that is when we earned the income. Okay. So they kind of go back over the 5 steps again. Okay. We have some special issues when it comes to revenue recognition. Okay. There could be some very specific requirements for contract existence. There in some of y'all are probably in legal environment of business right now. Some contracts have to be in writing. Some contracts don't have to be in writing. Okay. There could be prepayments, warranties, customers' options for additional goods or services. It could be any of that. There could be variable consideration, right to return. Okay, this happens in the textbook industry. So, like textbook brokers, they buy books, but they probably have a contract stating they can return any of those that they want to because they might order too many. And if they don't sell them, that puts them out a lot of money. Okay. Um, Seller as the principal or the agent, time value of money could be could be an issue because it could be a contract over not just 1 year, but over 2 or 3 years, or maybe even five. Okay. There could be various approaches to estimating that standalone selling prices. If you have a good standalone price, that makes it a lot easier to divide that out and kind of come up with a percentage. But you might have one that is so closely tied together, there's no way to separate them. Okay. Could be license franchises, bill and hold arrangements, consignment arrangements, and gift cards. One of the classic things I've heard over my teaching career, one of the things to, adjust cost of goods sold to however they want it, they may load up a tractor trailer full of inventory, take it out, park it in the yard somewhere, and don't tell nobody that inventory's in there. And then they go out there and they count the inventory, they have less, so then they're going to have a higher cost of goods sold. They may do that so that they can make the next period look better. Okay. Um, Management sometimes has incentive to perpetrate fraud because they may have a bonus based on net income or something like that and stock prices. Okay. Disclosures on the face of and notes to the financial statements are required. Okay. Some other special issues with step one. Contracts exist for purpose of revenue recognition only if the buyer seller have approved the contract or committed. Each party's right regarding the goods and services to be transferred can be identified. Payment terms can be identified. The contract has commercial substance. We'll talk about that in another chapter, but commercial substance just means that you're in a different standing point than you were before the transaction. So where we talk about commercial substance is like if we trade a truck for a truck. We're really there's really it it probably lacks commercial substance because you just traded one truck for another. Okay. So commercial substance is usually identified as your standing before the transaction is very different after the transaction. Okay. It's probable that the seller will collect substantially all of the amount it's entitled to receive. Contract does not exist if the seller nor customer has performed any obligations under the contract. Both seller and customer can terminate the contract without penalty. Why did they even have a contract if they can do that, right? Okay. All right, we're going to go through another example here. We are looking at Comp Stores ordered 1,000 TriBox systems December 20th, 26 at a price of $250 per unit. Assume the Comp Stores and TruTech can cancel the order without penalty prior to delivery. TruTech made the delivery on January 1st, 2027 and received $250,000 on January 25th. Okay. When do they record? When does TruTech's arrangement with the comp store qualify as a contract for purposes of revenue recognition? January 1st, because January 1st was day delivery, and it said they could cancel the order without penalty prior to the delivery. Once the delivery happens, they can't do that anymore. Okay. All right. Not performance obligations. So we could have an extended warranty. Warranty is an extended, I am on the wrong slide. Sorry about that. I was looking at something. I was looking on my piece of paper on a different one. All right. Not performance obligations. Prepayments are non-refundable upfront fees for particular activities, part of the transaction. There could be quality assurance warranties. They obligate the seller to make repairs or replace products that later are found to be defective or unsatisfactory, part of the performance obligation to deliver products of acceptable quality. Okay, some performance obligations, extended warranties. Okay, a warranty can be extended if either the customer has an option to purchase the warranty separately, or the warranty provides a service to the customer beyond quality assurance. Okay. Options that provide a material right. They have a right to something the customer would not receive otherwise, so the seller's obligated to provide it. This could include software upgrades, customer loyalty programs, and things like that. Okay. We're going to go through, look at another one right here. TruTech offers a promotional coupon with every TriBox it sells for $250. I'm sorry, $240. The coupon gives TriBox customer an opportunity to buy a headset that normally sells for $150 for only $90. The coupon must be redeemed within 1 year of TriBox purchase. TruTech estimates 80% of the customers will take advantage of the coupon. They want us to prepare the journal entry to account for 100 TriBoxes sold for cash under the promotion. Okay, so we have an estimated standalone selling price of the coupon. Okay, discount 150 multiplied times 40% gives us 60. They said estimated standalone selling price 60 multiplied times 80% gives us 48. All right, so just so you know where these numbers are coming from, right here, this discount is 150. That came from right there. Multiplied times the 40% gives us $60. Okay. Then we're taking the $60 and multiplying that times 80% because 80% of the customers is what they are expecting to take advantage of that. Okay. So we have a total standalone price of $288. So we'll take the 240. Let me do it over here really quick. 240 and 48 equals 288. I like doing it like this. You take the 240, divide it by 288, and we get that 83.3%. 48 divided by 288 should be the difference, 1667. Just a little hint, these two numbers should always equal 100%. Okay, so right here at TriBox, we're going to take that 240, multiply it times 100 units at 20 to give us $20,000. The coupon, which we've already calculated that, multiply that times the 100 units gives us 4,000. So we have our total 20,000, 4,000, and 24. Okay, we're getting cash of the 24 total. We're going to go ahead and record sales revenues of 20,000. We're going to have an account deferred revenue on coupons for $4,000. Okay, and as we fulfill that obligation and sell those headsets, we will gradually take out of this liability. Okay, so deferred revenue coupons, that is a liability. All right, I will see you all on the next video.